You see the headlines all the time, right? Company X makes record profits. But what does that really tell you about the health of a business? Today, we're going to peel back the layers, look past those big, flashy numbers, and find out what truly makes a company great. And trust me, the answer might not be what you think. Let's get into it.
So let's start with a really simple question. When you think about any business, from a tiny corner store to a massive corporation, what's its number one goal? What's the one thing it should be laser focused on?
For most of us, the answer just pops right into our heads, doesn't it? It's got to be profit. Make as much money as possible. The more profit, the better the business. It just feels like common sense.
But what if I told you that focusing only on profit is kind of like looking at a car's top speed without ever asking about its fuel efficiency? That a company with a lower profit margin could actually be a much, much better business. Yeah, you heard that right. Let's find out why.
Okay, so first things first. Let's talk about the metric everyone knows, the net profit margin. It's definitely an important piece of the puzzle, but you have to see it as the starting line, not the finish line.
So, what is net profit margin? It sounds complicated, but it's super simple. It's just the percentage of pure profit you get from a sale after all your costs are paid. So, in this example, you buy a pencil for 10 rupees and you sell it for 15. The 5 rupees you pocket is your profit. That means you have a 33.3% margin on that sale. Pretty straightforward, right?
Now, this is where it gets really, really good. We're about to go way beyond the profit on a single sale. We're going to ask a much more powerful question. How good is a business at making money from the money that was invested in it? To understand this, let's meet two guys, Ram and Sham. So here's the setup. We have Ram and Sham. Both of them start their day with 100 rupees to invest in their new pencil selling business. Ram decides to go for the high-end market, selling his pencils for 20 rupees each. That gives him a huge 50% profit margin. Sham, on the other hand, sells his for just 15 rupees, earning a smaller 33.3% margin.
Now, looking at these numbers, who would you put your money on? Based on profit margin alone, Ram looks like the genius here, doesn't he? He looks like the clear winner. But here comes the twist. Because Sham's pencils were so much cheaper, customers were lining up. He sold out, reinvested his cash, sold out again. And by the end of the day, he'd sold 30 pencils. Ram, with his high prices, only managed to move 10. You see, volume makes all the difference in the world. And this whole story brings us to a far more powerful metric called return on equity, or ROE. Now, ROE doesn't really care about the margin on just one item. It answers the fundamental question. For every single rupee I invested in this business, how many rupees of profit did it spit back out for me? It's the ultimate report card. So let's do the math for Ram. He started with 100 rupees. He sold 10 pencils, making 10 rupees of profit on each one. That's a total profit of 100 rupees. He literally doubled his money. That's a fantastic 100% return on equity. But now, look at Sham. He also started with 100 rupees, but by selling 30 pencils at a 5 rupee profit each, his total profit for the day was 150 rupees. His return on equity is a mind-blowing 150%. So here's the big lesson. Despite having a lower profit margin, Sham's business was way more effective at creating wealth.
And this quote just hits the nail on the head. The real purpose of a business isn't just to sell things for a high markup, it's to turn a small pile of cash into the biggest pile of cash possible as efficiently as it can.
And hey, this isn't just a fun little story. This plays out in the real world all the time. Take a look at these two real companies. Eicher Motors has a great profit margin, 20%, and a really solid ROE of 24%. But then you look at Page Industries. Their margin is much lower, it's just 13%. But their ROE? It's a phenomenal 48%, almost double Eicher's. They are masters at making their money work for them.
Okay, so by now we're all thinking, great, high ROE is the secret sauce. But there's a catch. There's always a catch, right? We have to ask, where is that high return coming from? Because sometimes it's coming from a very, very risky place. Debt. And this leads us to a super important question. If you see a company with a crazy high ROE, should you just get excited and jump right in? Well, not so fast. It's totally possible to artificially pump up that number. Check this out. Imagine two companies. Company A on the left uses only its own money. That's the equity, 100 rupees. It makes 20 rupees in profit, so its ROE is 20%. Clean and simple. Now look at company B. It only puts up 50 rupees of its own money and borrows another 50 from the bank. Even after it pays interest on that loan, its profit is 14 rupees. But because it only used 50 rupees of its own money, its ROE suddenly jumps to 28%. It's financial magic, but it can be dangerous.
Now, using debt to boost your returns seems really clever when business is booming, but it is a classic double-edged sword, and what looks like a genius move in the good times can become an absolute nightmare in the bad times.
And here's why. The interest on that debt has to be paid, no matter what. The bank doesn't care if you're having a slow quarter. They want their check. And if a company hits a rough patch, those mandatory interest payments can literally be the thing that forces them into bankruptcy. The best of the best companies know this, and they're very careful with debt.
So after going through all of that, how do we tie it all together? Let's build a simple, practical framework that you can use to spot a truly high-quality company.
Here it is, a simple and powerful three-step check. Step 1, you can start by taking a quick look at the net profit margin. Step 2, you immediately pivot your focus to the return on equity. That's the hero number. And then step 3, and this is the most critical of all, you must check the debt-to-equity ratio. That tells you if that shiny ROE is the real deal. So the winning combination, the true sign of a great business, is this. You want to see a high and steady ROE, ideally over 20%. But, and this is the kicker, it has to be achieved with very little or even zero debt. You combine that with stable profit margins, and you've found the gold standard.
Let's just say this one more time, because it's the single most important thing to take away from all this. The best company is the one that earns the highest return on equity with the least amount of debt. Period. End of story.
So the next time you see one of those headlines about record profits, I hope you'll stop and ask a few more questions. Look a little deeper. Will you just see that one surface-level number, or will you now be able to see the real underlying story of the business? That's what this is all about. Thanks for tuning in.